Good morning all and welcome to today's video. So today I have the same three pairs on watch, and those are Kiwi dollar, Aussie dollar and pound dollar. The DXY is still moving sideways. That's the dollar index for those that don't know. That's still moving sideways, so that will have a large bearing on what these pairs are doing, given that they are dollar related pairs. So in times such as these, we have to just remain patient. It's certainly been a month for patience, November, but patience is primarily the name of the game in trading. So I'm going to break these down for you now and give you my thought process as always. Thanks for tuning in. If you're new to my videos, if you're a veteran of them, then welcome back. It's a pleasure to have you as always. So Kiwi dollar on the higher time frames, the narrative as I see it, the picture that I'm seeing when I break these down from the higher time frames, these pairs, is as follows. So you can see price came up, it near missed to this area here, but it tapped into this area. Okay, it came back down, filled this wick. We did wick to this area of value, okay, which is what we did wick through it, sorry, which is normally what we see when we push to the downside. But sometimes when it occurs as a wick, the wick gets filled and then we push to the downside, and that's what happens in this instance. We then have this 1, 2, 3. Okay, with a 1, 2, 3 middle section, we push back up, break the high, and then push back down. That gives me a clue. Particularly, I meant to touch on this yesterday. When we have an impulse down followed by a correction, the correction forms below. The key bit is below this low. That tells me that price did not find enough liquidity here to send it to the upside to potentially take out this near miss, which is often what we see when price near misses to an area of value. This correction underneath this low tells me that price did not find enough liquidity there to send it to the upside, and that potentially this is just an impulse correction continuation to take out this near miss to here before potentially price pushes up to then take out this near miss to here, which it failed to tap into last time around. So that's the higher time frame picture as I see it. Of course, things can change. If the DXY does sell off, then the picture could change on these pairs, because if the DXY is weak, then obviously the Kiwi dollar, Aussie dollar and pound dollar may move to the upside. But I'm just analysing the structure as I see it at this moment in time. Okay, and if things change, then we will reassess. So a clue for me on the daily chart. So just going back to this structure here, we come back up, we do break this high, but we do so by way of a bullish wick, a bullish candle with a big green wick above it. These candles in particular tend to get filled before price moves to the downside. That's what I've observed from my testing, and we scoot back up and then we do push to the downside. We then have that 1, 2, 3, which I was talking about, but what do we have here? We have a bullish wick. We have a green candle with a bullish wick above it, a green wick. That gets filled. But if we zoom in, you can see that we near missed the area on both occasions. This occasion and this occasion, we narrowly missed this area, giving me a clue that there's likely still liquidity there, which needs to be tapped into before we push to the downside. Okay, and that's what happens. We break above, which is primarily what we do on the higher time frames before pushing to the downside, and then we have that impulse correction continuation confirming the move to the downside. If we then look at this on the daily chart, we then have this price left a footprint. It left a footprint here by way of this wick. We then have this 1, 2, 3, where the second one is a wick. The bullish wick gets filled. Notice that again. Bullish candle with a big green wick above it, that gets filled. We then push down, and then we have this 1, 2, 3 middle section within this 1, 2, 3, within a potential 1, 2, 3 move to the downside. Okay, and at the end of it, we have an ending structure. Okay, so we have this kind of ending structure where we have this 1, 2, 3 with a 1, 2, 3 move in it. And if we just drill down to the 1 hour chart, you can see that we have that middle section. Where the waves are You know, whether you say this is the 123 or whether you say this is the 123 is irrelevant. We have that kind of completed move, that 123 move. Okay, it doesn't necessarily matter how many waves, just as long as it's not one straight line. Okay, because when there's one straight line like that, then it implies that that move is not completed. And you can see we are exhausting. You can see this exhaustive price action. We are exhausting where I would anticipate we exhaust, which is this area of value. And one of the reasons why is because there was an exchange of liquidity here last time around, which caused price, if we just zoom back out, caused price when we exchanged here last time around to completely smash through. Whoops, let's try that again, shall we? Cause price to completely smash through this low and all of this volume that was built up here, okay? Giving me a clue that there's a lot of liquidity sat at this area of value, which is why I've marked it as my area of value, okay? And perhaps why price is exhausting at that area. So with all of that in mind, I'll be looking for the following. If we tap into that area of value, we push down and we flag, then I will be looking to get short either on the break of this flag or within it. And then I would be able to manage this down to the start of this corrective range for something in the region of 4.5%. And of course, if we continue to push that, usually we react from the base of a piece of structure or the base of a corrective channel. So if we break that one, we would then likely find our way down to the base of this channel for something in the region of 15 to 16%. And of course, if we break that, okay, and we find our way to the base of that structure, I don't think you need me to drag the risk to reward tool down to there or drag it down to this low here, which price failed to tap into last time around. So that is Kiwi dollar. I'm going to move on because I'm limited for time on these videos. I'm going to leave the forecast on the chart. Aussie dollar is going to be a similar picture, but notice that there we go. Price is tapped into the area of value and it's now pushing down. So let's just break this pair down for you now. Aussie dollar, we have that on this one. We scoop back up, we tap into that area. Notice the candle before, look at it. It's a big bullish candle with a green wick above it. We come back up, we tap into that area again, fill that bullish wick, then we push to the downside, and then we have this kind of 1, 2, 3. If you're wondering why there's kind of 4 touches there, why I'm saying 1, 2, 3 when there's kind of 4 touches, when we don't really move away from the overall structure, I just see that as 1 touch. Okay, so we're looking at the drives essentially. We're looking at the first drive, second drive, and typically speaking, the third one is the one to go. But notice in this instance, it doesn't. Sometimes when we get a third touch, we get a scoop double top before the move to the downside, and you can see given the way that Aussie dollar has been moving, it seems to like moving in these scoop double top manner. Okay, we even have that here to some extent. We have that kind of 1, 2, 3, first drive, second drive, third drive, and then price comes up, scoop double top before the drop. So this seems to be a characteristic of Aussie dollar, and because the market always repeats itself or has a habit of repeating itself, it's important to pay attention to these things because how the market has moved in the past can determine how it would likely move in the future. Okay, so we then push to the downside, and once again, as with Kiwi dollar, we kind of correct here below this low, giving me a clue that there was not enough liquidity here to send price to the upside, like for that longer term move, potentially to start tapping into these highs. That could still happen. We do have to be mindful of the DXY's positioning, but if we just look at this low here, we only kind of wicked to the area. Okay, we didn't wick. We wicked to it, crucially, and not through it, giving me a clue that we may come back down to tap into this area and to tap into this low, which price failed to tap into last time around by way of this near miss here. Okay, we also have an intentional footprint there. Okay, and if we just look, you can see that price, we're always asking ourselves, how did price move to an area of value? You can see that we moved up structurally by way of 1, 2, 3. What do we have here? If we just drill down, of course, this candle is still active. Okay. We just drill down to the 4 hour. You can see that we tapped into that area by way of a 1, 2, 3, and exhaustive price action, and a 1, 2, 3 middle section, giving me a clue that that middle section is complete as well. We tap into that area where price sold off aggressively from last time around. There was an exchange of liquidity here, which caused price to completely smash, as with Kiwi dollar, all the way underneath these lows here. Okay, so if we just drill down, you can see if this candle closes like this at 6 a.m., it is now 5:46 a.m. as I speak. This could be a very good sign that we're likely to sell off. Okay. And if we just zoom in a little bit, we do have to be aware that we have a bullish wick here. What have I just said? We have this bullish 1 hour high test. So this wick may be filled, but don't forget that the higher time frame holds more weight. So this candle would hold more weight than this 1 hour bullish wick, and and the chance of that being filled. So you can see if we just measure the impulses within a piece of structure, we have an impulse correction continuation. Okay, so we've kind of filled. If we assume that the impulse correction continuation, the continuation leg out is of a similar length, we've kind of filled almost 90% of the length of this now. So price may react from here. We will also have this little corrective channel in here. Okay, so what I'll be looking for, once again, is the same thing, but in this instance, you see I did this forecast last night, and this is what I did this when price was somewhere down here. Price is tapped into the area of value, and if it pushes down after this video, I'm going to set a little Google Calendar reminder to remind me to check this periodically to see if we get that move down followed by the flag, and then I would be checking this kind of every hour just to see if we get this flag. And if we do get it, then I will be looking to get short on the break of the flag or within it, and then I will be able to manage it down to this low as a first kind of solid inflection point for something in the region of 2 to 3%. And then once again, just as with Kiwi dollar, if we found our way to the bottom of the range, then that would be 11%. And then, of course, those higher time frame targets that I just showed you a moment ago would apply. So that is Aussie dollar. As I say, I'm going to set a Google Calendar reminder in a minute to remind me to check this now that we are already at the area of value, and my alert has already been triggered. So that is Aussie dollar. And if we just go down to the last pair, which is pound dollar, and just zoom in. So on the higher time frame, the narrative is that we have this structure here. We have this completed 1, 2, 3. Okay. We have a near miss here, which failed to tap into this high. And we have a 1, 2, 3 middle section, giving me a clue that in the long term, we'd likely see an impulse correction continuation to take out that high and hit the 90% rule of this start, what we call the 90% rule. So the start of a piece of structure. Okay. We have an example of an impulse correction continuation here, but price is pulling back. So there may be a potential to capitalize on a short-term move before we get either that, or we get some kind of, we get something more like this, which comes back down, taps into that area again, and then takes out that near miss and that high, which we near missed too. Okay. But that's, kind of for the birds, because that's super long forecasting. But that's we may be able to capitalize on a short-term move to the downside, because we have, as I drill down to the daily, we have this piece of structure here. We have a 1, 2, 3 middle section, a 1, 2, 3 last leg leading down to it, a reversal structure which taps into that area, breaks below, catches people the wrong side of the market and pushes up. Within that, we have a 1, 2, 3 middle section. Okay. And then after that, price left us with an intentional footprint. Okay, so what do I mean by that? You can see that price came down here sharply and then pushed up, giving me a clue that there was a big exchange of liquidity, especially as we rallied from that area and broke above these highs here. Okay, the other clue that we may be pushing down to tap into those lows is because we have a near miss. So price near missed to this sharp hook point. It doesn't need to come all the way back down to the start of this piece of structure, because that is a completed piece of structure. but it may come back down to here before pushing to the upside. The other clue is that we've moved up in a very non-progressive way. We've moved up. Look how we've moved up. We've moved up correctively. Okay. We didn't move up like this in a series of tight flags, which is usually just the banks stacking the orders. We moved up in a very non-progressive manner. And as I drill down, I have to be mindful of these videos because I only have 20 minutes to discuss what I'm looking for. We have a hook point there, which caused an exchange of liquidity and price to smash through this low here, all of this volume. Okay, so there may be liquidity sat there, which causes price to move to the downside. However, you can see the price hasn't really reacted from this area. If anything, it's reacted from this area. Okay, but because we would be out of this structure, I would not be looking to, for price to kind of tap into this area and push down, because we would be outside of this structure. So what I would want to see was a break back within this structure. Okay. So I'm not, that's why I haven't got my rail on here, even though we do appear to have reacted here. Now you can see we have a bullish wick that may be filled. The other reason why this is, my computer is just frozen up a second. We'll just wait for that to, there we go. Right. The other reason why I would be wanting to see a convincing break below, let's just get that off the chart. The other reason why I would be wanting to see a convincing break below all of this is because if I just put that back in its box a minute, what we could be seeing here is a bull flag. Given that we didn't react from that area of value, what we could be seeing is something like this, okay, where we have a 1, 2, 3, a 1, 2, 3 middle section within it. We then tap into this exchange of liquidity here, and then this becomes a bull flag to push higher. Okay, given that would also make sense given how the DXY is positioned. It's just the non-progressive price action leading up to this, which gives me a clue that we may push to the downside. So I'm being quite neutral on this pair. But with all of this considered, what I'll be looking for is a clear break back beneath this area of value, and ideally back beneath this high here, because then that would negate the prospect of this just turning into a bull flag, like I just showed you, which pushes higher. If we get a little tight flag just below this, you could have a little tight flag like that. You'd be tagged in, tagged out, and then price does kind of what I was just anticipating, or what I was just showing you, and then we have that kind of 1, 2, 3 move. So a clear break back below this area of value, followed by a flag, and then I would look to get short on the break of the flag or within it, and I'll be able to manage this most likely down to this first inflection point for something in the region of 2%, 2.5%. And then, of course, just as with the other two pairs, if we reach the bottom of the structure, which is typically where price will do something more complex, I'd be able to manage this in the region for something in the region of 12%. And then, of course, if the longer term, I say longer term, but that kind of longer term, short term move, if you like, that I was looking for kicked in, we would have down to that bottom. Of course, very unlikely that you'd catch all of this move in one go, but the target area would be that low, which price near missed to last time around. And of course, there's kind of 35% or thereabouts down to that low there. So that is the higher time frame narrative. And if we're always, making logical decisions based on the higher time frame picture and the bigger picture from the higher time frames down, then we stand a very, very good chance of making money consistently if we're consistently doing that. Okay, so if we keep our processes consistent, keep our thought processes consistent, it becomes very, very difficult to lose money, because we're not making the kind of emotional decisions which cause the structures that we look for, and which I've just broken down for you, to actually occur in the first place. Okay, so I hope you've enjoyed this video, folks. I hope it has provided you with some value, and I will be back in the next video, and I will break down my thought process there. I will be looking for a long on this, just to touch on it, if that bull flag does occur, but obviously that would not be ready by the end of the day, which is why I've not put it on as a forecast. Thanks for watching, folks. Have a great day, and I will speak to you again soon.